Welcome back. Usually when we talk about the economy, we sort of treat it like the weather.
Right, like it's just happening to us.
Exactly. We say, inflation is up or GDP is down, as if these are just natural forces like rain or sunshine. But today, we're doing something different.
We're going into the engine room today.
Well, we are. We're popping the hood to see the actual mechanics of how factories get built, how national infrastructure actually gets funded, and how wealth is genuinely generated in this country.
It's a fascinating machine, really, once you stop looking at the sensational headlines and start looking at the actual schematic.
Absolutely. We are tackling the capital market today.
Yeah.
But before we get our hands dirty with stocks and bonds and the intricacies of the Sensex, I have a very specific and important message for our listeners. This deep dive is a full summary explicitly focused on UPSC preparation, and it is brought to you by the Simplified UPSC by PPP YouTube channel.
That's right. It's a dedicated resource for the serious learner who, wants to cut through the noise and get straight to the concepts that actually matter for the exam.
Exactly. So before we jump in, a humble request. If you find value in this, please subscribe to the channel. And if you are capable, consider supporting us on Patreon so we can keep bringing this super useful content to you.
Yeah, we also really want to give a massive shout out to all our current supporters.
Huge shout out. You guys help a lot in creating such content.
Truly, it makes all the difference in keeping the lights on and the research going.
And please don't forget to like the video and share your valuable comments. We do read them. Also, a crucial notification here, free notes with practice. Previous year questions, or PYQs, are available right now on our Telegram channel.
And for those who want to, go the extra mile.
For premium access, meaning you get all videos of this series at once, and their corresponding premium notes, which include detailed notes, extra PYQs, and model mains answers in a super organized way, you should join the private Telegram library. You can just DM us on the public Telegram channel to join.
Perfect.
Okay, housekeeping is done. Let's get down to business.
Let's do it.
So today's mission is to decode Chapter 17 of Sanjeev Verma's Indian Economy. But we aren't just stopping there.
No, we're layering in the conceptual clarity from Vivek Singh's book to make sure we have a complete 360-degree understanding of these mechanisms.
And of course, we're going to link all of this to actual UPSC previous year questions found in those sources.
That is the plan. Our goal today is to move beyond the jargon. I mean, you hear terms like bulls and bears or derivatives, and your eyes might just glaze over.
Oh, totally.
Mine used to.
Right. But we need to understand the structural mechanism here. How do household savings, your money, my money, actually get transformed into national assets?
That is the key question. So let's start at the very bottom. Foundation level. Let's do it.
When we say financial market, I think most people just visualize the stock ticker scrolling at the bottom of a news channel.
The red and green numbers.
Yeah, exactly.
Yeah.
But structurally, what are we actually looking at?
If we strip away all the screens and the shouting brokers on TV, the financial market is fundamentally a bridge.
A bridge.
Yeah. To understand it, let's use the conceptual framework provided by Vivek Singh. Imagine the entire economy is divided into two distinct camps. On the left side, you have the household sector.
That's us, the regular people.
Right. And specifically, these are the savers. They have income that exceeds their immediate consumption. They have what we call a surplus.
Yep.
Maybe it's in a savings account. Maybe it's cash stuffed under a mattress.
Right. So we have the surplus units on the left and on the right side.
On the right side, you have the business or government sector. These are the deficit units.
Meaning they need money.
Exactly. They have big ideas. They want to build a factory, lay a highway, start a new airline, or modernize a port. But they don't have the cash on hand to do it. They are in a deficit of funds relative to their ambitions.
So you basically have one group sitting on cash doing nothing, and another group desperate for cash to build things.
Precisely. And if those two groups never meet, the economy just stagnates.
Because the money under the mattress isn't doing anything.
It's rotting, really, losing value to inflation. And the factory never gets built, which means no jobs are created. The financial market is the intermediary mechanism that moves those funds from the surplus units to the deficit units. It mobilizes savings into investment.
Okay, that makes sense. That's the broad definition. It's the conduit. But Sanjeev Verma's text makes a very sharp distinction between the money market and the capital market.
Yes.
They both move money, right?
Yeah.
So what's the difference? Is it just the amount of money being moved?
That's a common misconception. It's not the amount, it's the time. And this is a really critical distinction for the exam and just for general economic understanding.
Okay, break that down for us.
The money market is for short-term funds. We are talking strictly less than 1 year, usually much less, sometimes just overnight. It's all about liquidity management.
Liquidity management. Let's translate that for someone who isn't a central banker.
Sure. Imagine a massive company or a bank. At the end of the day, they might be short on cash to meet their reserve requirements, or maybe they just need to pay a supplier by Friday.
Right.
They don't need a 10-year loan for that. They just need cash for overnight operations or maybe a few weeks. Or even the government. Maybe they need to bridge a gap for 3 months before the next round of tax revenue comes in. They use the money market.
So these are instruments like call money or treasury bills.
Exactly. It's like a cash advance or using a credit card to buy groceries. You need the liquidity right now, but you plan to clear that debt very quickly.
Perfect analogy. Groceries on a credit card. But today, our deep dive is strictly on the capital market.
Yes. And this is for medium and long-term funds, anything more than 1 year. This isn't for groceries. This is taking out the mortgage to build the house. Or in a company's case, issuing shares to build a massive steel plant that won't even turn a profit for 5 years.
And this connects directly to that concept Sanjeev Verma emphasizes so heavily: capital formation.
Yes, absolutely.
I feel like this term gets thrown around a lot in the news and economic surveys without people really grasping what it means.
It is the absolute heartbeat of economic growth. Think about it this way. Consumption, buying a burger, buying a shirt is good. It drives demand today. But it's fleeting.
Once you eat the burger, it's gone.
Exactly. Capital formation, on the other hand, means creating a productive asset that will produce more goods in the future. If Maruti Suzuki builds a new car plant, that is capital formation.
Because that plant will keep producing cars for the next 20 years.
Exactly. It creates permanent jobs. It adds to the GDP year after year. But here is the catch.
There's always a catch.
Capital formation requires patient capital. You can't build a massive automobile factory with a loan you have to pay back in 30 days. You need money that is willing to stay put for 10 or 20 years.
Right.
That is why the capital market exists. It is the reservoir of patient capital.
Patient capital. That is a fantastic way to visualize it. So the capital market provides the runway for real economic growth.
Precisely.
Now, let's talk about the tools of the trade. If I'm a company and I need this long-term patient money, I can't just ask for a handout. I have to issue instruments.
Right. You have to give the investor something in return. And broadly, looking at Chapter 17, these instruments fall into two main buckets: equity and debt.
Okay, equity and debt.
And understanding the difference between those two is essentially understanding the difference between risk and obligation.
Let's unpack the equity side first. We hear about shares all the time. I bought shares in Tata, I bought shares in Reliance. What am I actually buying when I click buy on my app?
When you buy share capital or equity, you are buying a literal slice of ownership. You are becoming a part owner of that company. But here's the kicker. You are a residual claimant.
Residual, meaning I get the leftovers.
That is exactly what it means. Think of the hierarchy of payments in a business. The company makes revenue. First, they have to pay their suppliers. Then they pay their employees. Then the tax man takes his cut. Then they pay the banks and bondholders.
Right, fixed costs.
Yes. Whatever is left over after all of that, the profit belongs to you, the shareholder.
So if the company makes a massive unexpected profit, the leftovers are huge.
Correct. If the company doubles in value, your share essentially doubles. There is unlimited upside potential. But, and this is the risk, if the company goes bust, you are the last in line.
So I get nothing.
Usually, yes, you get wiped out.
So strictly speaking, equity is risk capital. There are no guarantees.
Zero guarantees. It is having skin in the game.
Okay, now compare that to the other bucket, debt. This includes debentures and bonds.
If you buy a debenture, you are not an owner. You are a lender. You are a creditor to the company. The relationship is totally different from equity.
How so?
Well, you don't necessarily care if the company becomes the next Apple or if it just stays a small, steady shop, as long as they stay solvent enough to pay you what they owe you.
Because I have a contract.
Yes, a contract with very specific terms. You have a fixed maturity, say 10 years, and a fixed interest rate, say 8%. The company must pay you that interest, regardless of whether they made a huge profit or just broke even that year.
And if they don't?
If they don't pay, you can drag them to court. You can force them to liquidate assets, sell their machinery to pay you back. You are higher up in that hierarchy of payments we talked about.
Okay, so summarizing that, equity is high risk, high reward ownership. Debt is lower risk, fixed reward, creditorship.
Bang on. And just to clarify a quick terminology point from the text for our listeners. Bond is technically just another term for debt.
Right. People use them interchangeably.
They do, but in India, we usually reserve the word bond for government borrowing or very large corporate issues, while debenture is generally used for standard corporate borrowing. But functionally, mechanically, they're both just loans.
Good clarification. Now, Sanjeev Verma throws in a term in Section 17.5 that usually scares people off.
Let me guess. Derivatives.
Yes, derivatives. It sounds like high-level calculus. Can we ELI 5 this? Explain. Like I'm 5.
It definitely sounds complex, but the core definition is literally in the name. A derivative is a contract whose value is derived from an underlying asset.
Derived from something else.
Exactly. The contract itself has no intrinsic value. It's just a side bet or a specialized agreement based on something else that is real.
Okay, give me a concrete, real-world example so I can picture this.
Let's step away from stocks for a second. Imagine a wheat farmer. He plants his crop today, but he is incredibly worried that by the time he actually harvests in 3 months, the market price of wheat is going to crash.
You want safety, certainty.
Right. He needs to know he can cover his costs. So he enters a future contract with a buyer to sell his wheat at, say, 100 rupees a kilo, regardless of what the actual market price is in 3 months.
So he is locking in his price today.
Yes. That contract he signed is a derivative. Its value depends entirely on the price of wheat. If wheat prices crash to 50 rupees, his contract is extremely valuable because it lets him sell at 100.
He's protected.
That's called hedging. Using derivatives to protect yourself against risk. But on the other side of that trade might be a speculator.
Someone gambling.
Someone who thinks the price of wheat will actually go way up to 150 and is willing to take the risk of promising to buy it at 100. So derivatives are used for both. Hedging, which is safety, and speculation, which is gambling on price movements.
Got it.
And in the financial capital market, the underlying asset isn't usually wheat. It's stocks or currencies or interest rates. But the mechanism is exactly the same.
Okay, that completely demystifies it. It's a layer on top of the actual asset. Now, I want to pivot from companies to the government.
The biggest player of all.
Exactly. Because while we talk about corporate stocks a lot, the government is the single biggest borrower in the economy. The Vivek Singh source gives us a lot of crucial detail on government securities, or GSECs.
This is truly the backbone of the entire debt market. The government issues securities to fund its fiscal deficit, basically, when it spends more than it earns in taxes. And Vivek Singh classifies them into 2 clear timelines, very similar to the broader market.
Short-term and long-term again.
Yes. For the short term, meaning less than 1 year, we have treasury bills, or T-bills. Now, these are fascinating because they are described in the text as zero coupon securities.
Zero coupon. Now, coupon in finance usually means interest rate, right? So zero coupon implies no interest.
Correct.
Why on earth would anyone buy a government bond if they don't get paid any interest?
It's a discount mechanism. It's actually really clever. Suppose a T-bill has a face value of 100 rupees. The government doesn't sell it to you for 100. They sell it to you today for, let's say, 98 rupees. You hold it for its duration, maybe 91 days. When it matures, the government buys it back from you for the full face value of 100 rupees. That 2 rupee profit is your interest. It just wasn't paid out as a regular coupon. It was built into the discounted purchase price.
Implicit interest. That makes total sense. And what about for the long haul? If the government needs money for 20 years to build a dam?
For the long haul, anywhere from 1 year up to 40 years, you have dated securities. These are your standard traditional bonds. You buy it, and every 6 months, the government deposits interest directly into your account. And that rate can be fixed or floating.
Now, here is where it gets really interesting for our UPSC listeners. There was a specific question in the 2024 CSP exam, very recent, about exactly this.
Yes, that question tripped up a lot of candidates. It asked who is allowed to trade in corporate bonds and government securities.
And the options were things like insurance companies, pension funds, and retail investors.
Right. And historically, for decades, the answer would have been institutions only. For a long time, the GSEC market was an exclusive playground for big banks and massive funds.
Regular people couldn't get in.
No. But the landscape has completely changed recently. The Reserve Bank of India introduced the Retail Direct Scheme.
Which means what, practically?
Which means you and I, regular retail investors sitting at home, can now log online and open a gilt account directly with the RBI.
Wow.
We can buy government bonds without having to go through a mutual fund or a bank taking a cut. We can lend directly to the government of India. So if you see a question about whether retail investors can participate in the GSEC market today, the answer is a resounding yes.
That is a massive democratization of finance. It's
Oh.
great they asked about it. Okay, moving on to the next big concept in our outline. The word itself sounds like a complex medical procedure. Disintermediation. This is section 17.2 in Sanjeev Verma.
It's a very fancy academic word for a very simple everyday concept. Remember our bridge analogy from earlier?
Where the market connects the savers to the borrowers.
Exactly. Well, the traditional old-school bridge is a bank. You put your savings in the bank, and the bank turns around and lends that money to a company. In that scenario, the bank is the intermediary.
And obviously the bank takes a cut for providing that service.
A big cut. They pay you, say, 4% on your savings account, and they charge the company 10% on their corporate loan. That 6% spread is the bank's profit.
Right. So where does disintermediation come in?
Disintermediation is simply the removal of that middleman. It is when companies completely bypass the banking system and raise money directly from the public.
And they do that through the capital market.
Yes. Think about it. If Reliance Industries issues a bond directly to the public paying 8%, you as the investor get more than your savings account. You get 8% instead of 4%.
And Reliance pays less than a bank loan, 8% instead of 10%.
Exactly. Both the saver and the borrower win. The only loser is the bank, because they are disintermediated. They are cut out of the loop.
That's brilliant. And this direct raising of funds, this initial connection between the company and the public, happens in what we call the primary market.
Correct. The primary market is the factory of securities. It is where the security is actually born.
This is where we see the famous IPO.
Yes, the initial public offering. This is a private company raising money from the general public for the very first time. Now, the key distinction here, and listen closely because this is where a lot of students get confused, is where the money goes.
Okay, lay it out for us.
In the primary market, the money goes directly to the company.
So if I buy a share in an IPO, say the LIC IPO or Zomato, my money actually goes into their corporate bank account.
Exactly. It adds to their capital base. They use your money to expand their business, hire people, or build infrastructure. It is genuine capital formation.
Got it.
Now, let's say a company is already listed on the stock exchange, but 5 years later, they need more money to build another factory. They issue an FPO, a follow-on public offering.
And that's still the primary market.
Yes. Because new shares are being created out of thin air, and the money you pay for them is flowing directly to the issuer, the company.
What about when a company doesn't want to deal with the chaos of the general public? Dealing with millions of small retail shareholders has to be a compliance headache.
It is a massive headache and very expensive. In that case, they use private placement.
How's that work?
Instead of advertising on TV to millions of Indians, the company goes to 10 big insurance companies or maybe a few ultra-wealthy individuals and says, here, buy this large block of new shares quietly.
So they bypass the retail market entirely.
Yes, it saves time, it saves huge marketing costs, and it saves a lot of regulatory compliance headaches compared to a full-blown IPO. But, and this is the exam point, it is still a primary market transaction because the company is the one raising the fresh cash.
Okay, so the primary market is the birthplace. The company gets the money. But once I have that share from the IPO, I might want to sell it a year later. I don't want to be locked into this company for 20 years.
Right, and the company is certainly not going to refund you. They've already spent your money building the factory. That money is gone. That is exactly why we need this secondary market.
Which brings us to section 17.3, stock exchanges.
Think of the secondary market as the used car market of finance.
I love that analogy. It demystifies the whole thing instantly.
It fits perfectly. Think about it. When you buy a used Toyota from your neighbor, Toyota, the company, doesn't get a check.
Right.
Toyota got paid years ago when the car was sold brand new in the primary market. In the used market, the money is just changing hands between the previous owner and you, the new owner.
So the secondary market is exactly that.
Yes. Investors trading existing shares among themselves.
So when the news anchor is shouting that Maruti shares are up 5% today, Maruti, the company, isn't getting a massive inflow of cash into their bank account that afternoon.
Not a single rupee. It's just investors paying each other higher prices.
But it must matter to the company, right? Otherwise, CEOs wouldn't care about their stock price.
Oh, it absolutely matters because the secondary market determines their market valuation. A high, healthy stock price means they can raise more money much more easily and cheaply in the primary market later if they issue an FPO.
It sets the benchmark for future fundraising.
Exactly. But the daily trading volume, the billions of dollars moving back and forth every day, that's just money shuffling between traders.
And all this trading happens on the exchanges. Sanjeev Verma lists the big ones we need to know.
Yes, starting with the BSE, the Bombay Stock Exchange. It's the oldest in Asia, established way back in 1875, located on the famous Dalal Street. It's the historical nerve center of Indian capitalism.
And then the NSE.
The NSE National Stock Exchange came much later, in the early 90s, but it was revolutionary because it brought in fully electronic, screen-based trading right from the start.
Which must have changed everything. Speed, transparency.
Completely transformed the market. In fact, today, the NSE actually handles a significantly larger trading volume than the older BSE.
Now, the text also mentions some specialized indices that might really catch a listener off guard on exam day. Everyone knows the Sensex and the Nifty. But what about ICOMDEX and CRISPDEX?
These are prime targets for potential exam curveballs. ICOMDEX is relatively straightforward, tracks the commodity market. Things like metals, bullion, crude oil trading on the MCX, the multi-commodity exchange.
Okay, commodities and CRISPDEX.
CRISPDEX is really fascinating. It was developed jointly by CRISIL, the ratings agency, and SEBI. It's a sentiment index specifically designed for micro and small enterprises, or MSEs.
That is a great potential exam question. What does CRISPDEX measure? If you guess big tech or banking, you're totally wrong. It's small business health.
Exactly. It tracks the mood and economic outlook of the smallest players in the economy, the mom-and-pop shops and small manufacturers, which are completely ignored by the big indices like the Nifty 50.
Very important detail. We also need to properly define market capitalization, or market cap. You hear this thrown around constantly. Apple is a $3 trillion company, or Reliant is India's most valuable company. What is the actual math happening there?
It's incredibly simple math, actually. It is simply the number of outstanding shares multiplied by the current share price.
That's it?
That's it. If a company has issued 100 shares in total and each share is currently trading at 10 rupees, the market cap is 1,000 rupees. It's the hypothetical price tag of the entire company if you wanted to buy every single share in existence today.
But the text mentions a specific nuance. Free float market cap. Why the modifier?
This is a crucial distinction for how indices like the Sensex are actually calculated. Free float purposely excludes shares that aren't really up for sale.
Like what?
Like the massive blocks of shares locked up by the original founders, the promoters, or shares held by the government in a PSU, those aren't trading daily. Free float only counts the shares that are floating freely in the secondary market, available for you and me to actually buy.
So it gives a truer picture of the investable value of the company.
Exactly.
And before we leave the stock exchange floor, we can't ignore the zoo animals.
Yeah.
Bulls and bears.
Yes. Simple human psychology disguised as zoology.
How do you remember which is which?
It's all about how the animals attack. A bull attacks by thrusting its horns up into the air. So, a bullish market is optimistic, prices are thrusting upward.
Horns up.
Right. And a bear attacks by swiping its heavy paws down. So a bearish market is pessimistic, prices are getting swiped down, falling.
That is one of those visuals that just sticks in your brain forever. Horns up, paws down.
Visuals definitely help memory for the exam.
Okay, let's move into segment 5. With all this money flying around, primary markets, secondary markets, bulls charging, bears swiping it, can turn into the Wild West very quickly if nobody's watching. Someone has to play referee.
Enter SEBI, the Securities and Exchange Board of India. This is section 17.5 in the book.
SEBI is the ultimate watchdog of this whole ecosystem. It was technically established in 1988, but here's a really vital history lesson from the text. It was basically a toothless tiger until 1992.
1992 is the key date to remember.
What exactly happened in 1992 that changed everything?
The Harshad Mehta scam.
Of course.
The stock market exploded in a massive systemic scandal involving fake bank receipts and massive stock price manipulation. Post the 1991 economic reforms and then that huge scandal, the government realized they desperately needed a market regulator with actual statutory teeth.
They needed to be able to bite.
Yes, they needed the power to arrest, to fine, to halt trading. So SEBI was given full legal statutory power in 1992.
And what exactly is its official mandate?
Its objectives are threefold, very clearly defined. 1, protect the interests of investors. 2, promote the development of the securities market. And 3, regulate the securities market.
I want to drill down on that first one. Protect the interests of investors. Does that mean SEBI's job is to prevent me from losing money on a bad stock pick?
Absolutely not. And this is probably the most important conceptual takeaway regarding modern market regulation. SEBI follows a philosophy of disclosure-based regulation.
Explain the difference.
In the old days, pre-SEBI, the government actually used to try to decide if a share price was fair. They had an office that controlled capital issues. That was called merit-based regulation.
Let me guess, it was highly inefficient.
It was a disaster. It created bottlenecks and corruption. SEBI flipped the model. SEBI says, we don't know what the fair price of a company is. The market decides that. Our only job is to ensure the company tells the truth.
The truth, meaning all their financials are out in the open.
Exactly. So if a company is fundamentally a pile of garbage, terrible revenue, huge debts, awful management, but they admit in their prospectus that they are a pile of garbage, SEBI will approve their IPO.
Wait, really? They'll approve a terrible company?
Yes. Because SEBI approval is not a quality certificate, it just means the paperwork is honest and compliant. If you, the investor, read that document, see all the red flags, and still decide to buy the garbage company, that's on you.
Caveat emptor. Buyer beware.
Precisely. SEBI ensures transparency, it does not guarantee profitability.
That is a crucial distinction for the exam. Now, regarding IPOs, SEBI also oversees something called the book-building process.
Yes, which is just a technical term for price discovery.
How does that work?
Instead of the company coming out and stubbornly fixing the price at exactly 100 rupees, they give the market a price band, say, between 100 to 110 rupees. They ask institutional and retail investors to bid on how many shares they want and at what price within that band.
So the market demand actually determines the final launch price.
Exactly. It's much more efficient than guessing.
Now, there's a modern twist mentioned in the Vivek Singh notes that SEBI is grappling with today. Algorithmic trading.
Or algo trading. This is fascinating. It's the use of complex computer programs and mathematical models to execute trades at speeds that humans literally cannot match. We were talking microseconds.
Is that a good thing or a bad thing for the market?
It's a real double-edged sword. On the positive side, it massively increases liquidity. It makes it incredibly easy and cheap to buy and sell at any second of the day.
And the negative?
It entirely removes human judgment. A computer doesn't panic, but it is programmed to follow rules. If a certain technical threshold is breached, the algorithm might trigger a massive sell-off. And if all the algorithms trigger at the same time, it creates what we call a flash crash.
Where the market drops thousands of points in minutes for no fundamental economic reason.
Exactly. So it adds a totally new layer of systemic risk that SEBI has to monitor constantly with their own supercomputers.
It's basically a tech arms race.
It really is.
Right. Now, let's zoom out. We've looked deeply at the domestic machine. But India doesn't exist in a vacuum. We are part of the global economy. And to grow at 8% or 9%, we need fuel from outside. We need foreign investment. This brings us to segment 6.
This is a perennial favorite topic for UPSC. Specifically, understanding the stark distinction between FDI foreign direct investment and FPI foreign portfolio investment. Both Sanjeev Verma and Vivek Singh spend considerable time on this.
And we have a mandatory analogy here that really helps visualize the difference.
We do. Think of FDI foreign direct investment as a marriage.
A marriage.
Yes, it is long-term. When a foreign entity brings in FDI, they aren't just bringing a suitcase of cash. They are bringing technology, management skills, supply chains, and deep commitment. They want to build a factory, hire workers, and stick around for decades.
They want management control or at least a significant say in how things are run.
Exactly, and FPI.
If FDI is marriage, FPI is what? Dating.
It's dating, or maybe even speed dating. It's inherently short-term. FPI is a foreign fund logging onto the NSE and buying shares of Reliance or HDFC just to sell them for a profit 3 months later. It's purely financial.
No factories being built.
No. Sanjeev Verma explicitly calls FPIs fair-weather friends. If the Indian economy is booming, they pour money in. But the second there's a global crisis or inflation ticks up, they hit the sell button, dump the shares, and take their dollars back to New York or London.
They are highly volatile. Now, is there a hard mathematical line that separates an FPI from an FTI? Or is it just determined by their vibe and intention?
For regulatory and taxation purposes, you can't rely on vibes. You need a hard number. The Arvind Mayuram Committee standardized this for India. It's known as the 10% rule.
Break that down for us.
If a single foreign investor buys less than 10% of the total shares of a listed Indian company, it is legally treated as FPI portfolio investment. The assumption is that with less than 10%, you can't really control the company. You are just a passive investor looking for stock returns.
And if they cross that line?
If they buy 10% or more, it is instantly treated as FDI. Because at that level of ownership, the government assumes you have a lasting interest. You likely want a seat on the board of directors. You are married to the company's outcome.
This is so important. There was a direct PYQ in 2020 about this exact concept.
Yes, the question asked candidates to identify the key characteristics of FDI. And the defining phrase and the correct answer was that FDI is largely non-debt creating capital flow.
Non-debt creating. Let's emphasize that.
It's crucial. FDI is equity. The foreign company is taking a risk. You, as India, don't have to pay them fixed interest. If the factory they build fails and goes bankrupt, the foreign investor loses their money. The Indian government doesn't owe them a refund.
It doesn't add to our national debt burden.
Exactly.
Now, what about the dark side of foreign investment, or at least the highly mysterious side? The text talks about participatory notes, or P notes.
P notes. These are instruments used by foreign investors who want to invest in profit in the Indian stock market, but for whatever reason do not want to register themselves officially with SEBI.
Why wouldn't they want to register? If they have clean money, why hide?
Sometimes it's just to avoid massive bureaucratic red tape and compliance costs, but often it's about privacy, and that privacy can be exploited.
How does the mechanism actually work?
Let's say an anonymous wealthy investor in Monaco wants to buy Indian stocks. They go to a massive SEBI-registered FPI, someone like Morgan Stanley or Citibank. They hand over the cash and say, buy Indian shares on my behalf.
Okay.
Morgan Stanley legally buys the shares on the Indian exchange under their own name. Then, offshore, Morgan Stanley issues a participatory note to that anonymous investor.
So the investor participates in the economic profit of the shares without ever actually holding the shares or putting their name on an Indian registry.
Exactly. And the huge controversy here is that the Indian regulator, SEBI, historically had no idea who actually owned that money.
Which leads to the fear of money laundering.
And specifically a practice called round-tripping.
Like buying a round-trip plane ticket.
Exactly like that. Corrupt money illegally leaves India, travels to a tax haven like Mauritius or the Cayman Islands, gets washed, and then comes right back into the Indian stock market disguised as legitimate foreign investment via a P note.
To avoid taxes and launder the cash.
Yes. Now, to be fair, SEBI has drastically tightened the KYC rules on P notes in recent years to stop this, but the historical concept and the mechanism remain highly relevant for the exam.
Good to know. On the flip side of that, Indian companies also want to reach out and grab foreign money directly. They do this using ADRs and GDRs.
American depository receipts and global depository receipts. It's conceptually very similar to P notes, but operating in reverse.
How so?
Suppose Infosys wants to raise dollars from American investors who don't want the hassle of opening an Indian brokerage account. Infosys deposits a huge block of its domestic shares with a custodian bank in India.
Okay.
An overseas bank then issues receipts against those shares and lists those receipts on the New York Stock Exchange. That's an ADR.
So a guy in Ohio can buy a piece of Infosys in US dollars on his local exchange without ever converting currency.
Exactly. And a GDR is the exact same thing, just listed in other global hubs like London or Luxembourg instead of America.
Brilliant. Now, we have to mention Masala Bonds. It sounds delicious, but it's actually a brilliant financial tool that UPSC loves.
It really is an elegant solution to a massive problem. Masala bonds are simply rupee-denominated bonds issued to investors overseas.
Okay, stop there. Why is that special? If an Indian company wants money from London, why not just issue a regular standard dollar-denominated bond?
Because of currency risk. Usually, if an Indian company borrows $1 million from London, they have to pay back $1 million plus interest when the bond matures.
Right.
But what if the Indian rupee crashes against the US dollar in the meantime? Say it goes from 70 rupees to 85 rupees per dollar.
Then the Indian company has to spend way more of its rupee profits just to buy the dollars to pay back the loan. Their debt burden effectively explodes.
Exactly. The Indian borrower carries 100% of the currency risk.
So how does the Masala bond fix this?
With a Masala bond, the bond is denominated in rupees. The foreign investor pays foreign currency to buy a bond that is officially worth, let's say, 100 rupees. When it matures, the Indian company pays back exactly 100 rupees.
Oh.
If the rupee has crashed in the meantime, the foreign investor gets fewer dollars back when they convert it.
So the currency risk is completely shifted from the Indian borrower to the foreign lender.
That is the magic of the Masala Bond, and that was the absolute core of the 2016 PYQ. The key significance is that Masala Bonds shield Indian corporate entities from exchange rate volatility.
That is such a clear explanation. Okay, moving into our final segment of core concepts from the texts. Segment 7, mutual funds.
Section 17.7. Mutual funds are the quintessential vehicle for the common man. Look, you don't have the time to sit and research 5,000 listed companies, and you don't have the millions of rupees required to build a properly balanced, diversified portfolio.
So I hire a guy.
You pool your few thousand rupees with millions of other small investors, creating a massive fund, and a highly paid professional fund manager invests that pool into the stock market.
What's the main economic benefit here?
The absolute biggest benefit is diversification. Instead of taking your 10,000 rupees and betting it all on one single company, which is incredibly risky, the mutual fund buys you a tiny fractional slice of 50 different top-tier companies. It mathematically minimizes your risk.
But I want to be clear, it minimizes risk. It doesn't eliminate risk.
No, absolutely not. If a macroeconomic crisis hits and the entire stock market crashes by 20%, your mutual fund is going to crash right along with it. But you won't get completely wiped out to zero just because one single CEO committed fraud and bankrupted one company.
Right. Now, there is a historical conflict mentioned in Sanjeev Verma's text between mutual funds and something called ULIPs.
Yes, unit-linked insurance plans. This was a massive, headline-grabbing turf war back around 2010. ULIPs are essentially a hybrid product. They are part life insurance policy, part stock market investment.
Like a financial Swiss Army knife.
That is the perfect analogy. But as they say, a Swiss Army knife isn't a particularly great knife, and it's a really terrible screwdriver.
And it does two things poorly instead of one thing well.
Exactly. The core conflict, though, was regulatory. Life insurance is strictly regulated by IRDAI.
The insurance regulator.
Right. But mutual funds are regulated by SEBI. ULIPs acted almost exactly like mutual funds. They invested your money in the equity market, but they were sold by insurance companies.
Which means they bypassed SEBI's strict rules.
Yes. They often came with massive, hidden upfront commissions for the agents selling them, which SEBI had banned for mutual funds. It created a massive regulatory blind spot.
Who won the turf war?
It's largely settled now through joint committees and much better, stricter regulation of ULIP charges. But the expert opinion noted in the text and echoed by almost all independent financial planners is that you should generally keep these needs separate.
Don't mix them.
Right. Buy pure term insurance for cheap, high-coverage life protection, and buy standard mutual funds for your wealth creation and equity exposure. When you mix them in a ULIP, high mortality charges and long lock-in periods often eat significantly into your actual returns.
That is highly practical advice on top of being exam relevant. Now, quickly touching on the startup ecosystem funding. The text distinguishes between venture capital and angel investors.
There was a 2014 PYQ on this exact distinction. Venture capital, or VC, is defined as long-term equity capital provided to completely new, unproven entrepreneurs who have high-growth, scalable business models. VCs are usually structured firms managing huge pools of institutional money.
And angels.
Angel investors are usually wealthy individuals, often successful former entrepreneurs or sometimes just rich friends and family. They invest their own personal money in the very, very early stages of a startup, usually when it's just an idea on a whiteboard, before the VCs will even look at it.
They act as the guardian angels for the founders.
Exactly.
Finally, before we wrap the technical side, Vivek Singh mentions IFSC, Gifty City.
Yes. Gujarat International Finance Tech City. This is India's first international financial services center.
What exactly is an IFSC?
Think of it as a specialized offshore financial zone, but physically located inside India.
That sounds like an oxymoron.
Yeah.
Why do we need an offshore zone inside our own borders?
To stop capital flight and bring business back home. Historically, if Indian companies wanted to raise complex global capital, or if foreign funds wanted to trade Indian derivatives, they would set up offices in Dubai or Singapore or Mauritius.
Because the taxes were lower and the rules were easier.
Exactly. They hated the Indian tax regime and the heavy domestic regulations. Gift City is the government saying, wait, we will give you those exact same benefits, massive tax holidays, relaxed foreign exchange rules, easier labor laws right here in Gujarat.
So entities operating inside Gift City are treated differently.
Yes, Legally and for tax purposes, they are treated as non-resident entities, even though they are on Indian soil.
And it has its own dedicated regulator, right?
It does. The IFSCA, the IFSC authority, it acts as a massive super regulator just for that zone. It combines the powers of the RBI, SEBI, IRDAI, and the pension regulator into one single window.
So a foreign bank doesn't have to run between 4 different government buildings in Mumbai and Delhi to get approvals.
Exactly. It drastically improves the ease of doing business to compete with places like Singapore.
That is a massive, comprehensive overview. We have literally gone from the household saver hiding money under a mattress all the way to global offshore tax zones.
It's a wildly complex ecosystem, but when you break it down, every single part serves that one primary fundamental function, moving idle money to where it can create productive value.
Let's quickly summarize the journey. We started with the financial market acting as the great bridge between surplus and deficit units. We saw how the capital markets specifically build long-term assets through equity, which offers ownership and risk, and debt, which offers fixed lending.
We looked at the factory floor, the primary market, where capital formation actually happens through IPOs. And then we visited the showroom, the secondary market, where liquidity is provided through exchanges like the BSE and NSE.
We discussed SEBI's crucial role post-1992 as the referee, ensuring disclosure and truth rather than acting as a nanny guaranteeing quality. And finally, we traced the massive flow of global money into India through FDI and FPI, navigating the complexities of P-notes and Masala Bonds.
It covers a huge portion of the syllabus.
But Sanjeev Verma leaves us with a highly provocative thought at the end of this chapter. He notes that despite all this massive financial machinery we just spent an hour discussing, less than 1% of the Indian population actively trades or participates in the equity market.
It is a shockingly tiny number when you compare it to developed nations like the US, where over half the population has exposure to the market.
Yet, the Indian media is absolutely obsessed with the Sensex. Every single news channel has that ticker tape constantly running at the bottom of the screen.
It really raises a profound question for our listeners to take away and think about. As India actively transitions from a traditional savings-based economy where our parents just hoarded gold and bought land into a modern investment-based economy driven by financial assets, what actually happens to our society?
Well, expand on that.
If the primary engine of wealth creation shifts permanently to the stock market, how does that fundamentally change the social structure of wealth in the country? Is this massive financialization of the economy leaving the vast rural population completely behind?
Right.
If the Sensex is booming and hitting record highs, but rural wages are stagnating, does that green ticker tape really reflect the health of the Indian nation? Or is it just tracking the health of the top 1%?
That is deeply thought-provoking. Yeah. Wealth on paper versus wealth in hand. The expanding gap between Dalal Street and Main Street or rural India.
Exactly. It's not just finance, it's political economy.
All right, friends, that brings us to the very end of this extensive deep dive. A quick mandatory reminder. This detailed audio was generated strictly based on the book Indian Economy by Sanjeev Verma, specifically Chapter 17, with heavily integrated conceptual references from Vivek Singh's work.
All highly factual and carefully sourced for your exam prep.
Please, if you haven't yet, subscribe to Simplified UPSC by PPP on YouTube. If you are capable, do support us on Patreon to help us keep creating this level of content. A big shout out to our current supporters. You guys are the real patient capital investing in this knowledge factory.
Absolutely. We couldn't do it without you.
Don't forget to like this video, share your comment below. We genuinely love hearing your takeaways and debates. And check the Telegram channel for those free notes and practice PYQs.
And for the full organized library.
For the full library videos and premium notes, just DM us on the public Telegram channel to join the private library. Get organized and get ahead of the competition.
Happy learning.
Happy learning, everyone. See you in the next deep dive.